The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there have been profiting from the dramatic moves we've been seeing in volatility over the past week. My name is Mark Longo from theoptionsinsider.com, as well as many of the programs here on the Options Insider Radio Network. And I am joined, as always, on Volatility Views by my boon companion, none other than Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Happy to be here, as always. We're actually gearing up for some snow tomorrow, if you can believe that. You guys should be having it first out in...
Yeah, I don't know how it dodged us, but I have some family back east, and they sent me pictures of, they have an inch on the ground.
They're telling us to break out the snow shovels for tomorrow, so we shall see. Kind of scary in October,
yeah,
but
that's wrong.
Hopefully it's not going to last too long and warm up quickly after that.
That's why I'm getting out of Dodge to Florida next week, Don. I saw the snow coming.
That is a smart decision, my friend.
That's a smart one.
Of course, the trick will be getting my wife to want to come back at the end of it. We'll see about that. But,
yeah.
But yes, and that other voice, listeners, is none other than the Seabass, a.k.a. Mr. Slinky, a.k.a. the Greasy Meatball, a.k.a.
Mr. Slinky now.
a.k.a. Mark Sebastian from OptionPit.com, who is falling off his chair, apparently, in excitement to be on the show.
Oh, can't wait. I've been looking forward to this all week, Mark. I've been looking forward to this all week.
I know secretly this is your favorite thing we do all week, so.
It is. I'll tell you, I love getting to sit here and talk to, getting to talk to Don is, it brings me back to the days of sitting at the chair of my grandfather as he told old stories about things going on. And
no, that would be Alex Jacobson, actually, who does the old stories.
Alex Jacobson would be if my grandfather just talks. If it was my grandfather, but with my disposition for speaking.
You figure Alex is older than I am, huh? I'm flattered. I have to look that up. I think that's probably not true, but we'll see.
I don't know if you know this, but I've threatened for a long time now to have Alex host a show on my network just called Options Stories with Alex Jacobson, where he would reminisce for an hour or two.
Yeah, no, you should just call it, "Oh, did you say something?" with Alex Jacobson.
With all the seminars that I do and all the teaching over the summer, it still turns out that the most enjoyable parts all the war stories that we try to interject during teaching, because obviously you try to keep it light to the extent that you can, and being on
Don, that's what you're known for, is your light storytelling. Everybody says, that Don, he never gets into the gritty details of stochastics and standard deviation calculations, ever.
Yeah,
that's what they say about you.
All right. And with our team assembled, we will dive right into the Volatility Review.
It's time for the Volatility Review.
Okay, and welcome to the Volatility Review. This is, of course, the portion of the program here where we pick apart the recent activity in the world of volatility. And we usually kick things off, and since Mark's here live, we'll kick things off with him live with a look back at the world of just a general overview of volatility and what happened in our friend the VIX over the past week, sir. I'm sure you're pretty happy given that you've been leaning, let's say, somewhat to the downside over the past month or two.
Yeah, no, I mean, you could see this coming. And actually, we saw kind of the first inklings of something setting up on October 7th when a customer came in and bought about 60,000 of the VIX November 25 puts. And then a week later bought another 140,000 of them, followed up with another 20,000 the following day of people piggybacking. That was kind of an inkling that there were some thoughts that VIX was starting to break. You actually, the first time, it was really interesting. If you listen to what I said on Monday's show, on last week's show, I mentioned how vol was running up all week, even though the SPX was up. Well, we finally saw that weird correlation break on Wednesday when the S&Ps were up about 1%, and we saw the VIX down over 6.3%. We saw it down like 7%. So it was actually moving a little bit more than down than the SPX was moving up. Well, that was a very, I wrote that day that was the chink in the armor. And then the next day, Thursday, we completely blew up. So the market actually gave everybody about a day's warning that something major was about to happen. Then yesterday, VIX priced in about yesterday, which was Thursday. We're filming this on a Friday. We saw VIX confirm about 35 of the 45 points we moved. And then today we're actually down a little bit, but VIX is down. The reason being is that just because we're down a little bit doesn't mean that volatility can't come in, which is kind of what we're seeing. So, we've seen a complete break in the VIX and volatility in general. And I think we've got smooth sailing up to 1,300 now. And the fact that they're actually, I'm looking at those NOV 25 puts, Mark.
Yep.
What do you think? Vol up or down today?
On the 25 puts?
Yeah.
Well, given the fact that we see a lot of degenerate premium sellers across the board there, so maybe people are getting out of their or closing out their positions. Unched, really?
Unchanged.
I would have thought maybe a little bit down today.
There's 60,000 of them trading. Vol hasn't moved. They are keeping they're hanging on to this stuff. I mean,
usually any chance they get to unload maybe before a weekend or something like that, they would take it.
They're holding this stuff. Don, your thoughts. Do you believe in kind of this? Are you kind of a momentum guy, or what kind of? You've been in the business for what, some 70 odd years?
Yeah, going on 4 score.
Yeah, exactly. What solace do you take in the movement of paper itself when you look at stuff like this as a trader and as an analyst?
Well, we often said when we saw trades, it matters terribly exactly who it is. We used to see some big block trades and an awful lot of volume, and we'd always say, who's doing that? Who's on the other side? We got to know people who we considered to be extremely smart. Doesn't mean anybody's ever right all the time, but people respect. And I'll give you an analogy. Some of our listeners are sports-oriented, and some of them may place an occasional wager on a sporting event. Sports lines move all the time during the week. Sometimes there are big moves, and sometimes people like to fade those moves, saying that it's public money, and quote my old economics professor, the masses are asses. So basically, you'd want to go the other way. But sometimes those moves are caused by huge amounts coming in from people who are extremely knowledgeable and who simply are right more than they're wrong. So to me, I guess there's paper and it kind of behooves you, when you see the kind of volume that you were talking about a moment ago, to try to find out, if at all possible, who's on the other side of some of these things, who's causing this, and basically whether these are forces that historically have been right more than they're wrong, and ought to command a certain amount of respect.
And that brings up a good point that tracking paper flow and order flow is an important consideration in any product where you're really diving deep into. We used to spend a lot of time and significant amounts of resources when I was on the floor to put together databases of precisely what you're talking about, Don, that type of order flow to track the big paper and the people who do X and Y. And it's definitely insightful to do something like that. It's a little difficult maybe these days in some of these products that are so liquid.
There are a lot of people with deep pockets, and
here, I'll mute myself.
Sorry. kind of behooves you to try to filter out, if you can, those who simply have an opinion and back it with cold cash, and those who in fact have an opinion that has turned out to be right a great deal more than wrong.
Yeah, like yesterday we were talking on the option block about, I forgot what name it was in the underlying, but we saw someone coming in with a significant amount of capital, obviously, and picking up nearly 100,000 of some ridiculous out-of-the-money lottery ticket call options, and that would not particularly be the type of paper I would look to track on a regular basis, unless you wanted to fade it.
No, not at all.
I would not put a lot of stock in that sort of paper. Size money is not always the smart money.
No, but I can tell you this: if Goldman came in and they wanted to do their own trade against their customer, you wanted as much of that trade as possible.
Right.
That was always the case.
I was picked off enough times by Goldman to have learned that lesson, as everyone on the floor probably was if you traded after 2:55 p.m. All right. And Don, of course, we also talk about the broad spectrum of volatility products here, including the euro, which has been having quite the wild ride over the past week. It's been a fun time to be watching euro vol, Don.
Absolutely. It's been quite a roller coaster, and I saw a chart this morning just of the last month. I believe that the euro began October somewhere in the $1.32 range, and I believe that as we speak, it's about $1.41 or so, and it certainly just didn't get there straight line. There has been quite a ride, such that the front month vol contract, which is the 1 month November realized volatility that will expire a week from today, has had a ride of its own. We've mentioned every month how these monthly contracts will give you opportunities in one direction or another for some 25, 30, even more % movement during their life. Well, this one has been extremely interesting in that we've had actually 2 moves during the first 3 weeks, or 2 weeks even. I guess it's about 14, 15 trading days, 2.5, of over 30%. We went from 13.12 to a high of 18.32, so greater than 39% move to the upside. And then that 18.32 collapsed all the way down to 12.65, which was almost a 31% drop from the high. And then we settled last night at 14.73 on the way back up after yesterday's volatile day, not only in the stock market, but in the euro currency also, that was up about 2 cents or so. And, on a $1.30, 2 cents is 1.5% or so, which would be 24% daily volatility, obviously a lot higher than the 13 or 14 that it's trading at. So we've had a wild ride, as you say. We settled last night at 14.73, which is a little bit higher than the 13.80 from last Thursday's settlement when we did our last show, when you'll remember I hedged a little and said, not too sure where this is all going. We've had a lot of volatility, didn't want to make any bets, and I think we're probably right to do that. So we'll save any forecasts for later on in the show, but the review is that you've had an interesting ride this month.
Definitely. Every time we do this show, it makes me want to just dive into the euro again. I haven't traded euro actively in quite a while, and just all this activity going on, particularly in the realized space, just makes me wet my whistle for some euro action. Let's just say it's been quite.
It makes you drink. It makes you drink alcohol to This Euro stuff?
Yes, it does. It just pure grain alcohol. It's so exciting.
Then again, just about anything makes Longo drink alcohol. But
what, you mean I shouldn't be drinking whiskey at noon Central Time? Is that too early?
Well,
should
all
I switch
I know
to water?
Is that, I was drinking out of this beer at our last live show, and Mark had some unnamed bottle of clear liquid that he called water. I'm just not sure what that was.
Hardcore water. When you're doing the live business, you have to keep your wits about you. Sebastian takes the opposite approach, that the more alcohol he can cram in before the show, the better.
More alcohol equals me being smarter and clever and better looking.
Exactly. Far more attractive, I would say, yes.
Oh, absolutely. That's what everyone says. When you drink, you get better looking and funnier.
Yes. And you are living proof of both things, sir. All
exactly.
Right. Yes, but yes, all this Euro action has indeed, let's say, piqued my curiosity, perhaps a better term, for diving into the Euro and the Euro vol contracts, because these things are moving quite a bit these days. We'll see if at the end of the show we can pick up a few more islands for our listeners there in the Bahamas, Don.
Yep.
All right, and with the volatility review complete, we're going to roll on into our volatility viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint. This is, of course, where Don and I and a guest today, Mr. Sebastian, parse and dig deep into some particular options topic or theory or formula. Last week, you'll recall, we dove into why you guys actually over at Volex decided to kick out the mean when you're looking at your vol contract formula. I know that was a question we had received in several forms over the past few months from our listeners who have been parsing the contracts. And one of the things we talk about a lot on the show, in fact, you just talked about just now, Don, on the vol review, is the fact that these contracts have such an intra-day range and such movement to them. And I think there still is, for whatever reason out there, a perception or misperception that these contracts are really still kind of, end of day close and open type trades where you come in, you put your bet on for realized vol throughout the day, and then maybe you close it out a day or two later at the close. But there is, as we've discussed many times on this show, quite a bit of intraday action in there. And some of that also has an impact on how you guys like to structure these contracts and the way that we can look at them going forward.
Well, I'm going to try to do Bob Kraus, our chairman, proud in the next few minutes, because this is probably his very favorite topic. It's difficult to talk to him for more than about 2 or 3 minutes on the subject of vol contract futures without his getting around to, let me tell you about something very interesting about vol contracts. Day trading, the convexity in the vol contract futures, and opportunities intraday.
I can concur with that, Don. I just went to a hockey game with Bob a few weeks ago when he was in town for FIA, and we did indeed get around to that topic. So I can
to your seats yet, or was it as you were walking?
I think as the usher was showing us where to go before we even sat down.
Anyway, I'm going to point our listeners to an article that we have on the website, but before I do, I'll try to summarize the topic. And I think it is actually a very interesting one, and one that does provide opportunities. If listeners are anywhere near arm's length to grabbing a calculator quickly, or they're in some room where they can get one, go ahead and grab one for a second just to follow along.
I'm grabbing mine now.
That I'm going to say is kind of easy, and you can trust me on the numbers, but it's fun to crunch them yourselves anyway.
I'm not sure that Fisher-Price calculator may not do it there, Mark.
No, just plain arithmetic, easy stuff.
Yeah, every time I press a button, it says 6, and then it says, but it's in Elmo's voice.
Right.
So it goes, Elmo says number 6. That's
so suppose we are
get that
towards the end of a realized volatility period, and we're 20 days into a 1-month contract that's been demonstrating about 20 volatility, kind of reasonable number. And we've logged all that volatility. So we've got this partial volatility that's almost the end of the line. We've got 1 day to go. And we find that intraday on the last day, around noontime, the market's up very sharply, about 2%. So we look at that point and we say, I wonder what kind of implications this has for what's going to be the settlement price or the expiration value of this contract. After all, we've logged 20 days worth of 20% volatility. And yeah, we're up 2% today, but this is just one day in the calculation. And so we start to speculate as to what might happen from this point on. In other words, it's kind of wiping the slate clean and saying, what's going to be the action from now until the close? Well, obviously, we could stay unchanged and still be up 2% when they ring the bell. Or we might be on a huge rally like yesterday and have a lot of momentum and blow right through that and go up another 2% from where we are. Or, of course, we might retrace. We might give it all up and fall back 2% to unchanged. And so we're fond of saying that, volatility calculations are irrespective of direction, and that on a day, if you finish up 2% or down 2%, it's the same data point into the calculation. But this is something very different. This is already having that 2% in your pocket, if you will. The market's up 2% intraday at noontime, and now I consider the potential symmetry of going up yet another 2% or dropping back 2% to finish unchanged. And the part that's so interesting is when you crunch the numbers and you do the calculation as to what that further movement up or down would be, you get a very, very different outlook on what this movement can be, because it's not symmetrical at all. It's asymmetrical, and it impacts the intraday pricing of the contract. So let me crunch some of the numbers. If you've gone through 20 days of 20% volatility, you know that this is a squaring function. So we square the 20%. 20 squared is 400. And we've got 20 days worth of that 400. So 20 times 400 is 8,000. That's kind of the contribution to the root mean square calculation. So now we have 8,000 kind of in the bank, if you will. And now we consider what might be the contribution for the very last data point. Well, if we were to go up 2% from the 2% up that we already are, that would be a 4% move on the day. And a 4% move daily is almost like 64% volatility annualized by that, 16 factor or square root of 252. Well, if you just take that 64 and you square that for that one single day, you are contributing 4,094 more to the 8,000. The first 20 days contributed 8,000 to the calculation, and now I'm giving you 4,096 more on a single day's worth of up 4%. So when I go to total it all, it comes to 12,096, and now I divide by 21 days worth of data. That's 576. And finally, it's a root mean square calculation. You take the square root, and you get 24. The 20 that we had for 20 days would go all the way up to 24 for the settlement, the expiration value, if we were to move up another 2% from the noontime already up 2%. Well, what would happen if we fell back 2% instead? If we fell back 2% from up 2%, we'd be unchanged on the day, so that would be a zero contribution to the overall volatility calculation. So we had 8,000 going in, and if we were to drop back to zero, we add nothing to that, so the 8,000 now gets divided by 21 days, and then we take the square root of that, and we get 19.52. Let's call it 19 and a half. So look at what's happening. We started out with 20. We're up 2% on the day. And what we're saying is from that point on, if we were to go up another 2% from there, the contract would expire at 24. But if we were to go down 2% from there, the contract would expire at 19.5. We could be up 4 and down only a half with exactly the same movement from noontime on. So the curve of that action, if you will, is not at all straight line. It's not at all symmetrical. There's an exponential value to going up further. And that causes us to price the vol contract at that moment with the idea in mind that upside movement from that point is going to contribute a great deal more to the final value than the exact same movement would be to the downside. And that presents the opportunity for interesting intraday trading, particularly if you were to lean on the futures as a possible hedge against such movement, because the futures movement is linear. Now, supposing once you're up 2%, you took a long position in the vol contract, knowing that the kind of activity that I just described could take place between noon and the bell. And then suppose you sold a futures contract. Well, if you went up that 2% further that I was talking about, obviously it would have a huge effect on the final value of the vol contract, but a linear effect. You'd lose 2% on your short on the futures. Net, you'd probably profit if you had the kind of move that I was talking about. To the downside, what would happen if you finished it unchanged? Well, you sold those futures short. You'd make the 2% on your short sale, but you'd lose only half a point on your vol contract. So people might see a kind of an arbitrage here, but what we would expect to see is that traders, if they understand this phenomenon that we're speaking about, would actually have to price that into the value of the vol contract at noon. They'd have to know that you could do this kind of spreading with the futures contract, and they'd have to price the vol contract accordingly, in this case probably higher than one might expect if they just kind of said, well, maybe we'll just say that it's going to be up 2% on the day and calculate what that contribution will be. So this has some pretty important ramifications for day traders, for market makers who are looking to hedge a position in futures or in options, and particularly with the fact that we look forward to coming out with equity contracts for volatility, realized volatility trading in the near future. We expect that with the liquidity of the futures and the liquidity of the options, there can be some very interesting day trading opportunities here. We've summarized this phenomenon in an article on the website. So it's a few layers removed. You would first go to the drop-down menu and choose vol contract futures. And then in the sub-menu, it's opportunities. And under opportunities, we have our individual strategy articles. This one happens to be the third one, and it's called Day Trading Convexity in Vol Contract Futures. So we hope our listeners will take a look at that, find it interesting, and keep some of these principles in mind as you eventually come to trade some of our products.
I know, Don, that's almost a double tease for our listeners. It might be too much for them. You're hinting yet again at the promise of the equity index contracts coming soon to an exchange near you, as well as the possibility, or hinting at the possibility, of so much intraday action in these contracts. I don't know if our listeners can stand that
would be fun to tread.
The double tease.
Hopefully the ink is drying on some of the legal stuff as we speak, but we're surely getting closer.
Don't you dare announce it while I'm on vacation next week, sir.
And don't you dare call me Shirley.
All right, thank you for that, Don. And that's going to close out our Vol Viewpoint segment for this week. And now we're going to roll right into the mailbag.
Listener mail. Listener mail. Listeners write in.
Mail's in.
And welcome to the mailbag portion. This is, of course, the segment of the show where you, the listeners, take the reins. And today's question is an interesting one. It's a variation on some topics we've hinted at in the past, and it's a very common question we receive here at the show in various ways, shapes, and forms. And it comes from our forum by a user who goes by the handle Jester, so I'm sure he's quite the humorous fellow. And the title of his thread is, How Would You Update the VIX? And he writes, Hello, since VIX is still the brand name for volatility with much of the investing public. No commentary, sir. I'm just reading the question.
I wrote an article on this. For Expiring Monthly.
Perfect timing that you should be live on the show this week, sir. Then you could play in the old mailbag. But Jester writes, since VIX is still the brand name for volatility with much of the investing public, I would like to know what tweaks/upgrades you would suggest for future iterations of the VIX. Thanks, and I enjoy the show very much. I'm sorry I wasn't able to make it to the live show in Chicago. It sounded fun. Well, Jester, you did indeed miss a fantastic live show, including Don working his best booth babe outfit. It was quite impressive, if not a little bit scandalous, if I do say so myself.
I was surprised he went with the coconuts.
Yes, it doesn't seem like a tropical fellow to me. That kind of surprised me a little bit as well.
It caught me off guard, yeah. I was expecting more of like a Aphrodite look.
It could have been that or the 17 beers you had before the show started that caught you off guard as well. One or the other. But Jester, this is a great question, and it's something we've discussed a lot. In fact, Don and I kibitzed about this after the panel last week as well, and I think you guys would probably agree that if there was, let's say, a hypothetical update to come down the road to VIX, maybe they launch a VIX 2.0, a VIX revision, what do we think they should address first? And I think you guys would probably agree that the focus of much of the consternation around VIX these days seems to come in around the settlement process and how that settlement is calculated, in the fact that it could settle sometimes even outside the range of where the index has been, which has led to many sleepless nights for many people trading in this product. And of course, a lot of that has to do with a concept that Don, you and I discussed a couple of weeks ago, which is of course the way that settlement and the way the index itself is weighted, giving that inverse weight to the strike price there in the denominator. So of course, by doing that, that gives a even greater weight to the smaller, tiny, out of the money strikes than the put options that are the focus of a lot of the quote-unquote manipulation concerns that people can come in and they say the way the VIX is structured right now, putting that strike price in the denominator. As the denominator decreases, obviously that number gets larger. And so doing that, and then of course putting in bids in some of these strikes that have no business having any bids whatsoever, and the correlating vol values that come off of that can then have a very large impact on the VIX itself, and maybe a surprisingly large, disproportionate. Thank you, sir. That's why I have you on the show. You're my other half. And so yes, a disproportionate impact on the VIX itself. And so Don, is that where you would start as well, you think, with a VIX and with the way that the settlement is calculated and the way that index is done, giving the weight to the strike price in that fashion?
Well, I think once before we had a similar question, and I said, I think I'll take the fifth and let you guys try to advise VIX on how to make a better product while we develop our own. So short of suggesting that what they really need to do is have a realized volatility.
Yeah, short of saying diving into realized vol.
Yeah.
But in fact, trying to really just be as objective as possible, because I'm not the one writing the articles, there has been a tremendous amount of literature on the subject of the potential for manipulation in the settlement price. Again, that's not volatility exchange. That's not a personal viewpoint, and I'm not looking to start controversy. It's simply a matter of fact that there's been a great deal written about this. And you pinpointed how relatively simple it is to do that, because VIX is constructed to give more weight to out-of-the-money puts than out-of-the-money calls. And the mathematics of it is such that just a slight bid up in any of these very distant, far out-of-the-money puts can have a disproportionate effect on the final reckoning or settlement price. So again, I'm not editorializing and I'm not making any suggestions, but this is something that has been a great concern and for quite some time.
Don, controversy follows you wherever you go, sir. You just can't shake it.
Yep.
Mr. Seabass, since you're live today,
I have a list about a mile long on things I want to change about the VIX. Number one.
Don't help him too much, Mark.
No, I mean, I sat down. I sat down with the research department and told them what I thought, and because I'm not going to go on national. I'm not going to talk, nationally without talking to them first. Number one is this ridiculous concept of including everything that has a bid in it. There is Don, Mark, me. We're all option traders. When options get to a certain price level, they stop being about volatility and start being about that specific price level. Does that make sense? Don, you remember, did you ever use the term unit options? Long units, kind of just the real cheap stuff that you never wanted to sell. And it would have some sort of, a ridiculous implied volatility like 70, but it was really just a nickel, right?
Well,
that's not volatility.
That's exactly right. And when people ask about prior to the crash, when you guys were in diapers, but prior to the crash, when you take a look at what, was called the smile as opposed to the skew that we have now for implied volatility by strikes, in fact, for the great range of strike prices, it wasn't even any curve at all. They were the same implied volatilities for everything. Then for the far out of the money calls and the far out of the money puts, you would have this little bit of an upturn, and it was for the reason that you just mentioned. Basically that, anybody would be willing to pay. In those days, we said a teeny, a 16th, 6 1/4 cents. Anybody would be, for a lottery ticket. So that basically you had that for the far out of the money puts, the far out of the money calls. Theoretically, maybe they were worth a penny or 2 cents or 3, but people would pay a 16th or an 1/8 for them. And that would make it look, when you applied the formula, like there was some gigantic implied volatility, but it was all smoke and mirrors. It just didn't mean anything.
Yeah.
Right. And that's exactly. So first thing I would do is I would develop some sort of minimum contract value.
Yeah, some sort of relevancy factor.
Right. For SPX, I always said $2. Anything below $2 is no longer volatility. It's a unit. And now the other issue they have, and this is turning into a major issue, especially in those, they've got these like 30-day vol on Amazon, 30-day vol on Apple. They're basically worthless because of the introduction of the weekly options, which is where all the event risk is now trading. And believe it or not, SPX and SPX PM and SPY are starting to see more and more of their activity, especially into event risk, trading those weekly options. Well, guess what? The calculation of the VIX drops everything that trades within 7 days. So the next thing you need to do is develop a way of calculating the VIX even into that Thursday night, because believe it or not, that expiration straddle is surprisingly accurate in the SPX. Now, it'll move, but even into that Thursday night, that at-the-money straddle is a real valuable measure of one-day volatility. It is. It is very effective. So what I'd like to see them do is some sort of we stop including options that have less than 10% of the value of the at-the-money strike on either the call side or the put side, or are worth less than $2. And then, what that's going to do is really kind of turn it from this thing that just takes every option into something that is slowly pulling in to where there's real volatility and kind of getting rid of the stuff that's more this unit risk.
That's interesting
and
because,
of course, Mark, what you're saying, of course, is actually the result of what I suppose, in my opinion, I would call an overcompensation. The original version of VIX, as you well know, was on OEX options, not the 500, but that's not the main point. The main point of the original version was that they used only the at-the-monies and one strike above and one strike below, and then a constant 30-day maturity. So it was on a very tight subset of options. It wasn't the entire list from start to finish. Now, some people took exception to that. They said you're not really representing the entire gamut of implied volatility. And so what they did was say, okay, you don't like that? We'll include every single option that's listed on every single strike, from the most ridiculously low out of the money to the upper ranges. And of course, this was at a similar time when you had the Black Swan and Nassim Taleb and all of his viewpoints.
Which was probably his worst book, believe it, if you ask me.
Without question. And so the result of that was...
Don, thank you. I love that he doesn't even say, you might be right. He just says, without question, it was his worst book.
Well, it's terrific to read a book from cover to cover like that and not see a single number in the entire...
No, dynamic hedging was a masterpiece.
It's mind-boggling. So
there's such a break between those two books.
So they revamped the entire way in which VIX was calculated, and sometimes, the saying goes, they throw the baby out with the bathwater, and now you've got this configuration that perhaps overcompensated and just went much too far in the other direction as a kind of a concession, if you will, to this tail event concept and to using these very far out of the money options. And as we just mentioned, getting an implied volatility that may or may not have any relevance or any real meaning when you consider how far away those options are.
Yeah, it's interesting. I think a lot of people, myself included, welcomed that change when they started to say, hey, we're going to take into account the full skew. It seemed like a fantastic change at the time.
I like the idea. It's just you've got to consider what is skew and what's not, what's a worthless option.
It's interesting you mentioned that, too, because I didn't realize the cutoff date was so long. I thought the cutoff date was a couple of days as opposed to 7
days. So any weekly option is not included in that calculation.
So they've overcompensated in the wrong direction. They wanted to get rid of options that were mostly gamma and theta, and that makes some certain sense, but maybe cut that lower and instead take that compensation to the wings where they haven't really compensated at all. And they should really address that relevancy instead of on an expiration cycle, also address it to the strike prices. Because
and what I'd like to see him is be willing to use, 2 or 3 different strikes, 2 or 3 different months. And obviously, you drop the weighting of that front month straddle, but to not include that straddle, to not include in the VIX calculation a straddle going into a weekly straddle that is going into the major employment number is ignoring a piece of volatility. It's even sillier in something like Amazon or Apple. I mean, can you imagine?
That's where all the paper is in Amazon and Apple these days.
Can you imagine trying to trade Amazon VIX against earnings? Without the weeklies in there, it's ridiculous.
Not just that, it really skews the perception because then you're getting all the long premium trades and none of the short premium trades, which is where all the trades are congregating in the weeklies these days.
Yeah, my guess is, the only other solution is to keep the VIX as is, although I would still drop anything at least below a quarter. All right? Make these guys pay for putting a bid in there. And then maybe add a super short-term VIX. They've got VIN and VIF. Why not add VIW or something like that? Just so people could look at it.
Yeah, that's probably the next question is, and where does this go? Do they revamp the existing product or probably launch something new with some sort of these variations we discuss?
I think that they need to revamp the existing product as is anyway.
I don't know how willing they will be to do that, but an interesting...
I can tell you how willing they will be.
No question, as Don would say.
Yeah. One word,
without question.
I like that.
Well, we're talking about math, and we're talking about what seems reasonable to us as traders, and obviously this is an exchange or more than one exchange that has a franchise-making product. And the old saying goes, if it ain't broke, don't fix it. We may think it's broke from a theoretical point of view, but if the volumes are off the charts and business is good, then the exchanges may feel that it's not broken, and we don't really need to fix it. So,
but this is the type of problems that you run into when you have traders. We have mathematicians that don't trade versus traders that are mathematicians or mathematicians working with traders. Like that skew index they came out with a while back, in theory, could have been a great idea, but they gave it zero relevance when they included nothing to stick it to.
Right.
You know? I mean, you look at it and go, it's 117% of what? You know, what does that mean?
Right.
And, you know, that was where we developed the CBOP and
the
a few
widely
other
held
things.
CBOP.
Yeah, I still want to use that thing. I'm actually working on a new calculation that is going to be kind of a twist on the VIX. You know, my goal is to try and take the price sensitivity out of the VIX calculation.
We should do a weekly CBOP update in your appearances here on the Vol
I think
Views.
that would make some sense.
For the 6 people who are following that index, they would love to hear that.
They would like to hear that. Let me take a look and see where the CBOP is.
Hold on to it. We'll save it for a tease for our listeners for the Crystal Ball segment.
Okay.
All right. Listeners, that is going to do it for the mailbag this week, but thank you for that question, Jester. A very interesting and provocative question, that fun one to discuss for us. And now we're going to roll right into the Crystal Ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball segment. This is, of course, the portion of the show where we gaze into the murky ether of the future and try to divine what the markets hold in store for us. And Mr. Sebastian, I hope you've got your CBOP calculations at hand, sir, because you get to kick us off here in the Crystal Ball segment.
You know, I am looking at the market in general, and I see a lot of slowness coming up. You know, talking VIX needs to drop another point from here anyway just to make up for the move from Thursday. But I think we're heading for kind of a slower period. We're not going to be able to keep a realized vol of 60% going in the SPX. I mean, it's just impossible. And so I think we got to slow down. I think we're going to creep between 1250 and 1300, and you're going to see the VIX trading 22. In terms of the euro, I would be, as Don would say, sold to you. I am a seller of 14.75 volatility that it closed at yesterday, and I'm actually a seller of the euro itself. I think it rallied a little too hard, and so I am in a rare occurrence. I am a seller of S&P and a seller of S&P vol, and I'm a seller of the euro and a seller of euro vol. What do you think about that, Don?
You, sir, are a degenerate premium seller across the board.
Oh, and the CBOP.
Oh, the CBOP.
I apologize. Yes. We almost went without the CBOP. It is trading at. I will have it for you in 1 second. I got to do some math here.
Told you that Fisher Price calculator wasn't going to cut it.
I know. Sorry. So we got to do. Let's see. 24.
Can Elmo do square roots? I didn't realize that.
Elmo say 122 times 24.06 divided by 0.96. And
this is compelling radio.
It is. We've got the CBOP at 31.59. 31.59, folks.
There you go. A significant premium to the cash VIX.
That is expensive.
Might be sold CBOP.
Well, basically it says the vol's high and skew's not flat. There's significant people holding downside premium.
You need to list this product so I can execute that ARB.
There you go.
Printing money in the CBOP VIX ARB. All right, and Don, speaking of printing money, which islands in the Bahamas are we going to get for our listeners this week with our Eurovol predictions?
I like to represent and give a voice to Robert Engel at the Volatility Institute for the work that he provides for us in his forecast vols that we call F-vol for forecast vol using the Garch methodology. And everything is considerably lower forward-looking, 1 month, 3 month, even 12 month he goes out, Euro forecast. So 13.16 for the month, 13.04 for 3 months, 12.57 out a year. And basically, as we sat with the settlement at 14.73 last night, and 1-month historical backward looking has been 14.10 on the euro. I'll be happy to agree with Mark and say that if we'd like to predict an expiration value for our front month contract next Friday, I'm going to go lower from where we are right now.
You said those bids are hovering around 13.60 right now, so that's where people could get in if they want to start hitting some bids in the euro vol right now.
Right.
All right, sir. Thank you for that. And that is going to do it for this episode of Volatility Views. I want to thank both of my partners in crime here for joining me on the show today. And Don, let's start off with you. You said you have some interesting announcements and some developments coming up over at Volex.us that our listeners might be interested in.
We've been working on crunching a great deal of data, and I think we announced several weeks ago that we're also very eager to get all of our information on Bloomberg, and we are, in fact, negotiating with them to have all of our series and indices up and running very shortly. And to kind of coordinate with that, we're putting together all sorts of applications for the website that, again, should be coming very shortly, and we'll tell you more about them when they're all in place. But they're going to allow you to take a look at these forecast vols from the Volatility Institute and overlay them, if you will, with a lagged historical volatility that will cover the same period and sort of let you see just how accurate some of these forecasts are in a very wide variety of all the assets that we cover on our website. We're also going to have a comparison, a multiple comparison application where, again, you can pick 2, 3, or as many of the assets that we currently feature and overlay 2, 3, 4 graphs of historical 1-month, 3-month, 12-month volatility, or any of the forecast volatilities to compare, contrast, be able to do spreads, intermarket spreads. So we've got a lot of extra functionality that's coming down the pike, and I'll let everybody know when they're actually up and running.
Well, thank you for that, sir. And Mr. Sebastian, since you joined us live this week, what is coming up over in the land of Option Pit that you think would interest our listeners? A little birdie told me you might be heading out to Vegas soon.
I'm going to be hanging out in Vegas.
Is that your well-known roulette seminar?
Yeah, no, I'm going to be doing two things. I'm going to be doing I've got a presentation on Friday, a presentation on Saturday. I'm going to be manning the booth. I'm going to be doing some live in-person pit reports and trading demos, which should be really fun. And I'm going to get to hang out with
the Traders Expo for our listeners who don't know what you're talking about.
Yeah, the best-looking man in the trading industry, Charlie Barwas. So, which I'm looking forward to.
I was going to say, I didn't know Don was going to the Traders Expo.
No, Don, I'll tell you, Don is a fine-looking man, but that Charlie, he could host a game show. He is so good-looking.
This is twice now I've heard you pontificate at length about Charlie's looks.
I'm
starting to wonder about you, sir.
He's got great hair. He's tall. He's handsome. Always has a perfect spray tan. Nothing you can complain about the guy.
He's a good
friend.
I'll
be on the phone to Charlie, warning him.
And listeners, he is indeed one of the many men over there who makes the Volex exchange tick. So, Mark,
we're going to be right by them actually. So come visit us. Come visit Volex.us, and come to the trade show. You're going to get to meet me. Don, you will not be there, correct?
No, I can't make this one, unfortunately.
But Bob will probably be there, right?
Yes.
All right, so you get to meet Don's sub-in, Bob Kraus, and again, the aforementioned Charlie. And, maybe me and Bob can record something on that Friday from the floor.
I think you should. That would be great.
That'd be very fun, actually. Thank you for that, and listeners, look forward to that. You can see the whole VolViews team, sans me, and Don, of course, out at the Traders Expo next week in Las Vegas. If you are going to be out there, be sure to swing by. I believe you can even win a Kindle from Mr. Sebastian, or Kindle Fire. Fire. One of the first to get your hands on the new tech there in Las Vegas. And be sure to visit theoptionsinsider.com to check out our new redesign, which is really heavy on the radio content. So all of you radio listeners, it's much easier easier for you to find your favorite shows and listen to them and subscribe to them and all the other fun stuff we have up there for our radio listeners. So by all means, surf on over to theoptionsinsider.com and let us know what you think. Kick the tires and light the fires, as they say over on the website. And thanks again for listening, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.